Hello everyone, welcome back. The week ahead could bring some of the most important and riskiest days of the entire US earnings season. Microsoft, Meta, Amazon, and Apple will report earnings within a very short span of time, while the Federal Reserve will also announce its latest interest rate decision. Before we begin analyzing this week's key stocks, we need to understand one point, something we have repeatedly emphasized in previous videos. The real risk facing the AI sector is that earnings may not be impressive enough. Big tech companies must prove that they can generate sufficiently high returns. In other words, if these companies merely meet already elevated expectations without continuing to beat them by a wide margin, their share prices could still fall. Alphabet and Tesla have already taught us that lesson. First, Microsoft. Microsoft is the most important company this week because it sits at the center of the entire AI value chain. It has Azure Cloud Services, is deeply involved in the commercialization of AI models and enterprise software, and is simultaneously building a large number of data centers. After Microsoft reports earnings, if Azure growth accelerates and management clearly states that AI demand continues to exceed available supply, the market may conclude that the company's capital spending is indeed translating into revenue. Also note that if capital spending continues to rise sharply, while AI revenue growth does not accelerate in step, the market may respond as it did to Alphabet. Sell the stock for now. From a technical perspective, Microsoft has pulled back for several consecutive sessions from its highs ahead of earnings, closing near $381 on July 24th. The $377 to $382 range can be treated as a short-term watch zone. If the stock breaks below $377 after earnings on a clear surge in volume, it would suggest that the market is doing more than taking short-term profits. It would be reassessing Microsoft's AI valuation. Conversely, only a high-volume move above $389 after earnings, followed by a further recovery of the previous decline, would show that capital has genuinely accepted the new growth thesis. Before earnings are released, the area between these two zones is better viewed as a waiting zone than as a high-probability directional setup. 2. Meta. Can advertising profits cover its AI investment? Meta's core profits still come primarily from advertising. It invests in AI partly to improve content recommendation efficiency and keep users engaged for longer, and partly to improve ad conversion rates. If advertising revenue remains strong and operating margins stay stable, the market may conclude, although Meta is spending heavily, that investment is already generating returns. If capital spending guidance rises again while advertising growth fails to accelerate further, or if management signals higher future costs, the stock could suffer a decline similar to Alphabet's. Meta closed at $595 on July 24th. Around $610 is the first resistance level the stock needs to reclaim. The next confirmation area is near $625. If Meta fails to reclaim $610 after earnings and instead breaks below its recent low, the market may redefine it from an AI beneficiary to an AI heavy spender. 3. Amazon. AWS growth and margins must both pass the test. Amazon's earnings need to be assessed along two main lines: AWS cloud growth and retail operating margins. AWS is a major platform for AI infrastructure. If cloud customers continue to increase their demand for computing power, model training, and inference services, Amazon could become one of the main beneficiaries of AI spending. But if capital spending rises sharply, while AWS growth or margins fall short of expectations, Amazon could still deliver the familiar outcome of good revenue, falling share price. Amazon is currently trading near $232. $230 can serve as the first watch level before and after earnings, while $235 to $245 forms the resistance zone for a rebound. If the stock can regain $245 after earnings, it would suggest that the market has accepted a new balance between AWS growth and capital spending. If the stock breaks below $230 and cannot quickly recover that level, it would suggest that investors are lowering the valuation they assign to future AI returns. 4. Why has Apple been relatively stronger? Among the mega-cap technology companies, Apple has recently shown greater relative price strength. On July 24th, Apple rose about 3.5% on increased volume and closed near $333. This suggests that some investors had already begun positioning ahead of earnings. What separates Apple from the other AI giants is that the market is watching not only data center capital spending, but also device sales, services revenue, the smartphone replacement cycle, and whether AI features can encourage consumers to buy new products. As a result, Apple may temporarily be viewed as the technology company facing relatively less pressure from capital spending. In price terms, $333 to $334 is the key short-term area to watch. If the stock continues to break higher on strong volume after earnings, its relative strength will be confirmed. If it falls back below $321, the pre-earnings rally may prove to have been little more than investors positioning ahead of the event. 5. The most important variable this week. The Fed could amplify volatility in AI stocks. When long-term interest rates rise, the present value of future profits falls, and richly valued technology stocks usually come under greater pressure. Therefore, even if a company reports solid earnings, a hawkish signal from the Fed, suggesting that interest rates must remain high for longer, could still limit the upside in AI stocks. Conversely, if the Fed's message is more dovish than the market expects and Treasury yields decline, technology stocks may receive support at the valuation level. This means the market could face a complicated combination this week. Corporate earnings push share prices higher, while the Fed pushes valuations lower. Or, earnings disappoint, but falling interest rates temporarily support the market. To sum up, many retail investors make the same mistake at moments like this. They interpret every intraday rally as confirmation of a new trend. In reality, during a week packed with major events, the first price reaction may simply reflect algorithmic trading and adjustments to options positioning. A more reliable signal is the full trading day after the earnings release, especially the closing price and trading volume. Here is our core advice. What truly matters this week is how capital votes after the news is released. A continued rise on strong volume after good news is genuine strength. If a stock cannot rise after good news, or even falls on heavy volume, that is itself a warning signal. In a market environment crowded with major events and extremely high expectations, making fewer predictions and waiting for confirmation is often more important than trying to place your bet before everyone else.